Jim, fantastic to have you back on ET Now. Thank you for joining us. Jim, when we started the year, the narrative was interest rates are low, interest rates will remain low, interest rates will not go higher, central banks will not do anything to disturb the current growth. But look at what is happening. Suddenly, shockingly, and surprisingly, US bond yields have gone from 1% to 1.75%. What is going on?
Well, I think there are two or three quite tricky related things going on. First of all, as the more and more vaccines are developed and the vaccination rollout continues around the world, the more optimistic people are getting about cyclical economic growth. Indeed, so much so that it's starting to make people think there is a realistic chance that inflation can pick up. And that's the first issue. The second one is particularly the Federal Reserve Board, the US Central Bank, but also others, have indicated that they would like and be happy for inflation to rise a bit, but not much. And we're now seeing a slight downside aspect of that from a conceptual perspective, because markets don't know what that means. And so the markets clearly don't entirely trust that the central banks won't change their mind if inflation were to start rising further. And thirdly, of course, is the simple reality that when it comes to value, many bond markets, if not virtually all of them, have very little value whatsoever. So if you put the three things together, it's not that surprising that we've seen what's happened in bond markets take place, and the knock-on effect on equities, given how remarkable the rally in 2020 was. And if I put it all together, it leads me to the view that central bankers have to be, as difficult as it is, a lot clearer about what degree of inflation they may tolerate as the recovery gets going. And it might be very hard for them, but if they don't, and as we get more and more recovery, markets on an erratic basis are probably going to continue to be a bit worried that central banks won't stick to what they told us before the recovery showed signs of appearing.
Jim, so let's understand. When interest rates were low, markets said, we want growth, we want growth, we want growth. Now growth is coming back. Markets are saying, why is growth coming back? Why is interest rates going higher? What exactly is the middle point?
So I think the way to square the challenges and the issues is what I'd term in terms of overall financial conditions. If bond yields continue to rise and it results in a significant decline in equity markets, and particularly from a US perspective, if it also coincided with a sharp rise of the dollar, then that should and would make the Federal Reserve Board very concerned. And I think they would throw a clear signal, possibly implying that they may reaccelerate their own bond purchases to try and stop an unhelpful tightening of financial conditions. The Fed has, even before this chair, through much of the reign of Ben Bernanke and even Janet Yellen, spent a lot of time following the predictive capability of financial conditions indices, which includes bonds, equities, and the dollar, and in some cases house prices. And they definitely will not want to see a vicious circle taking place in financial markets, because that would mean any economic growth won't last very long. And so long as we're not going to get a big rise in inflation, I think ultimately the celebration that you say in your question is probably the right approach, but it's going to be bumpier as we go through recovery. And it's something that, to be honest, I've kind of broadly expected. For the rest of the world and emerging markets, ultimately, really what's crucial, I think, is what happens to the dollar as a result of this.
So in a rising rate environment, do you think that, concerns that prevailed, for instance, the taper tantrum back in 2014-15, do you see those kind of concerns returning?
I mean, I think sadly, bouts of that are inevitable. And again, as we've discussed before, and something I'm in the process of writing about for IMF's magazine, we live in a world where the international monetary system is highly asymmetrically distorted with the power of US financial markets. And it doesn't really make a lot of structural sense because what ends up happening, and it's happened throughout my career, is the Fed goes into super easing mode and the rest of the world's financial markets benefit dramatically. And then the Fed goes into tightening mode and the opposite happens, and sometimes in a pretty savage way. And we're going to be stuck with that system until we have a much more diversified global capital markets and financial system in which, crucially, a lot of other countries, India included, aren't so dominated by what happens to US financial markets and the US financial system. And I pray that that day will come in the future, but it's not going to be around the corner. But it is pretty ludicrous because the financial markets dominance of the US system are way beyond the relative importance of the US economy to the modern complex world.
Okay, what about commodities then? They're saying the reflation trade is now back, with oil at 70, copper prices also at a record. Are you expecting some kind of nervous unwinding?
I can never resist saying when people ask me about commodities, particularly oil prices, the only thing I'll guarantee for you is they're not going to stay stable. They don't do stability. And so I suspect as we get more and more evidence of many economies starting to recover, I think we'll probably see commodity prices rise further. And I wouldn't be completely surprised if oil prices, for example, went above $80 a barrel in coming weeks and months. But let me quickly add, I wouldn't be that surprised if they didn't stay there either and ended up coming back down. I don't do the kind of analysis I once did in any detail, partly because I'm not in the professional business to do so, nor do I have the same support staff. But it seems to me, for a world economy that has growth potential of somewhere between 3.5% and 4%, a fair value range for crude oil prices is probably something in the $60 to $80 a barrel region. And of course, because of how crude oil tends to trade, we'll probably trade outside of that region at times as well. But I would expect that in coming weeks and months, we're going to see further increase in oil and other commodity prices.
Right. Jim, so what's in store for India in this kind of an environment? Because, India typically does well when globally interest rates are low and oil prices as well are low.
Yeah, I was just thinking as I was saying it, when you put what I've said so far together for India, it's not going to be potentially a great few weeks because, as you've said, and let me emphasize it, historically, of course, Indian markets don't like rising oil prices because of India's dependency on imported oil especially, and nor does it seemingly do well with rising interest rates. So in that sense, you might end up getting some further sector rotation as it relates to Indian equities too. And I'm not sure there's a lot India can do about that other than not get overly worried about it because it's because of external factors outside of India's control.
Sure. So would you say that this decade belongs to India? Because European Union state is fragile at this juncture. US central bank is printing a lot of money and running a highly leveraged balance sheet. China has put a glorious, days in the past. Does this melting pot suggest that the decade could belong to India?
Possibly. I mean, I think it obviously will depend on, as we've discussed at length, what happens to global financial conditions. If we were to go into, a lot of your audience will not have experienced this, but if what we've seen recently goes into some modern version of 1993, which is probably the only severe bear bond market in my generation, everything got caught up in that, and India would as well. But on the assumption that we end up with this more pleasant outcome that we discussed, I think it's a great platform for India, partly because of the reasons you've said. India still has such powerful demographics relative to many other parts of the world. And we've seen a bit more sign of an appetite for more structural change in the recent budget. And India has a great potential to stand out economically this decade and to become a much bigger share of the global economy. And as part of that process, doing more for Indian consumers and Indian citizens to grow their wealth.
Jim, so who will be the ultimate beneficiary of this COVID crisis? Because we've seen that when crises happen, the lay of the global land changes. There are several crises which have rebooted the global trade, the global economic system, and also the global dominance. Now that India has emerged as the vaccine capital of the world, what does that mean for us?
Listen, it seems to me quite clear that this pandemic had a chance to disrupt what seemed already the growing clarity of a rise of a number of Asian economies relative to the rest of the world this century. And in the early evidence we've got as we come out the other side of this pandemic is that it looks to me that has not only has it not been disrupted, it actually also looks as though it could be accelerated. There's all sorts of fiscal challenges that many Western countries and their taxpayers face for many, many years to come. And it's not obvious how our financial system's going to be able to fully cope with it. So I think India, China itself, a number of other Asian countries are very well positioned for this to be an era in which they continue to become more important for themselves and in the world economy.